Welcome to you, Mr. Singh, and thank you so much for taking the time out for this special conversation on Business Today.
My pleasure. It's good to be here.
Thank you so much, sir. Let me kickstart by understanding from you, how have you assessed the quarterly earnings Q3? Already, called out for all our viewers to understand on the revenue and the profitability factor. We've also parked out that the labor costs or the kind of labor codes impact that has been seen industry-wide has also been seen at this point in time. There's also been an impact on the margins front as well. How are you assessing the earnings, and what's the outlook going forward? Do you see the residual impact of labor codes could also be seen in the future quarters, or do you see this is the one time and it gets over with Q3, sir?
Well, thank you for having me, and thank you for the question. When we look at the quarter, we're looking at a quarter at the end of which year to date, the firm is growing 32.8%. That obviously is not just robust growth. I suspect that's industry leading growth at the current point in time. In the quarter that just concluded, we grew sequentially by 4.4% in constant currency terms. What we found particularly reassuring about the quarter are also some of the underlying metrics when it comes to both the revenue and the margin profile. During the quarter three, which is a seasonally shorter and a weaker quarter for the industry, we've signed 6 large deals, which is the largest number that we ever signed over the last 2 years at least. Our next 12 months signed order book is now at $1.72 billion, which is 30% higher than where it was at the same time last year. Our key accounts, our top 10 accounts, are growing 47% on a YTD basis, and the free cash flow during the quarter came in at 110% to PAT. So metrics right through are metrics that we were very pleased to present to the market. On a go-forward basis, given the large deals that have been signed, given the deal velocity that we anticipate and the closures that we see in Q4, we feel that while FY26 was a very good year, has been a very good year for the firm, FY27 is likely to be an exceptional year going forward.
Revenue has seen an uptick. Which verticals are leading your revenue growth, and how much of it is led by AI?
Shelly, almost everything that we are selling, and the reason why we are growing at a time when the industry is struggling is given the fact that everything that we lead with is AI-infused. At this point in time, the high-tech and the healthcare verticals, Shelly, are growing almost 100%. The exact number is 95%. And these were nascent verticals about a year back. Together, these two are now 10.5% of our revenues. Travel is growing almost 60% year to date, and both banking and insurance are growing in the ballpark of 20%. So it's broad-based growth. It is broad-based across industries. It is broad-based across regions, and it's also broad-based across client size cohorts that we have.
Right. Mr. Singh, like you pointed out, 6 large deals, $593 million order intake. How much of this truly converts into near-time revenue versus back-ended execution? And also, if you could highlight for all our viewers, how would the deal pipeline look like from here in Q4 in the early quarters of FY27 as well?
So actually, over the last 9 years, the next 12 months signed order book, which we call order executable, the movement in that metric has been very tightly correlated with the actual revenue growth that we've delivered in the subsequent 12 months. So the fact that this metric is currently at 30% gives us great comfort that while we're growing at about 32, 33 odd percent right now, growth going forward should also be extremely robust.
The attrition is 10.9% and the net headcount additions are just 445. So what's the outlook on hirings for FY27?
We would continue to hire, Shelly. The intent is to continue to hire given the confidence that we have in growth. Of course, with the extent to which we are trying to embed AI and automation across our operations, the growth in net headcount is likely to be lower than the absolute growth. But given the fact that absolute growth is expected to be very robust, incremental headcount growth should also be very strong. We are continuing to hire from campuses. We are continuing to hire laterally as well.
Right. Mrs. Singh, you have already earlier ruled out, newer verticals or geographies, at least for the next 3 to 5 years. Give us an understanding, and our viewers as well. Does this also mean no large acquisitions after Encora, or only no diversification beyond the core projects?
At this point in time, if you were to go back 9 years, we were focused on banking, insurance, travel. About 3 years back, we said we would also significantly across healthcare and the UK and Australia public sector. Those two bets have paid off extremely handsomely for us. I just shared the healthcare numbers with you. Out of the 6 large deals that we've signed in Q3, one was a new client, started off with a new large contract itself. From our vantage, the sixth vertical that is likely to take off and to pick steam post the Encora acquisition is going to be high tech, and you will, I suspect, see us stick to these 6 verticals at least for the next 5 odd years.
Wish you all the very best for the upcoming quarters as well, and hoping that we will get to chat once again in the next quarter. Thank you so much for being with us.